If I were starting investing in 2026, I wouldn't chase hype, hot stocks, or overnight success. I'd focus on building a system that works in any market up, down, or crashing. Because today's world is different. Higher interest rates, faster technology, and more uncertainty than ever. In this video, I'll share exactly what I would do from day one, how I'd protect my money, where I'd invest first, and the biggest mistakes I'd avoid so compounding can actually work for me. If you're starting fresh or want to reset your strategy for 2026, this is where you begin. Today we will talk about if I were starting investing in 2026, I'd do this. Understanding the 2026 investing environment first. If I were starting investing in 2026, the very first thing I would understand is that this is not the same world investors faced even 5 years ago. Markets in 2026 are shaped by higher interest rates compared to the ultra-cheap money era, rapid AI adoption, global geopolitical uncertainty, rising living costs, and faster information cycles driven by social media. This means easy money strategies, blind speculation, and get-rich-quick thinking are far more dangerous now. Successful investing in 2026 requires patience, systems, and emotional control more than luck or timing. I would start with my financial foundation before investing. Before investing a single dollar, I would make sure my financial base is solid. That means eliminating high-interest debt like credit cards and personal loans, because earning 8 to 12% in the market makes no sense if I'm paying 25 to 40% in interest elsewhere. I would also build an emergency fund, covering at least 3 to 6 months of expenses in a high-liquidity savings account. In 2026, financial shocks happen fast, job losses, medical expenses, or market crashes. So having cash on the sidelines is not a weakness, it's protection. I would invest automatically, not emotionally. One of the biggest mistakes beginners make is trying to feel the market. If I were starting in 2026, I would rely on automation. I would set up automatic monthly investments, so money gets invested whether markets are up, down, or crashing. This strategy, known as dollar cost averaging, removes emotion and timing risk. Over time, it allows me to buy more when prices are low and less when prices are high, which is one of the most powerful advantages a long-term investor has. I would focus on simple, broad market exposure first. Instead of chasing individual stocks or trending assets, I would begin with broad market exposure. Index funds and ETFs that track major markets would be my foundation. These give instant diversification across hundreds or thousands of companies. In 2026, with AI, automation, and rapid industry disruption, it's difficult to predict which single company will dominate long-term. Owning the market reduces risk while still capturing overall economic growth. I would not ignore global diversification. If I were investing in 2026, I would not keep all my money in one country. Global markets are more interconnected than ever, but growth happens unevenly. I would allocate a portion of my investments to international and emerging markets to reduce dependency on a single economy. This protects my portfolio from local recessions, currency risks, and policy changes while opening exposure to faster-growing regions. I would use bonds and cash strategically, not emotionally. Many beginners think bonds are boring, but in 2026, bonds play an important role. I would use bonds to reduce volatility and provide stability during market downturns. With interest rates higher than the 2020 to 2021 era, bonds once again offer meaningful income. I would also keep some cash available, not to time the market, but to take advantage of opportunities during crashes when quality assets go on sale. I would be extremely careful with crypto and speculative assets. If I were starting investing in 2026, I would treat crypto, NFTs, and highly speculative assets as high-risk bets, not core investments. While blockchain and digital assets still have long-term potential, they are extremely volatile and driven by sentiment. I would limit exposure to a small percentage of my portfolio that I can afford to lose completely. And I would never invest based on hype, influencers, or fear of missing out. I would invest in skills alongside the market. One of the most overlooked investments is investing in myself. In 2026, skills compound faster than money. I would invest in learning high-income and future-proof skills like data analysis, AI tools, digital marketing, automation, content creation, or sales. Increasing my earning power allows me to invest more consistently and aggressively over time, which matters far more than chasing high returns early on. I would keep costs and fees extremely low. These silently destroy wealth. If I were starting in 2026, I would avoid high-fee funds, unnecessary trading, and complicated investment products. Even a 1% to 2% annual fee can cost hundreds of thousands over decades. Low-cost index funds, simple portfolios, and minimal trading would be my rule. The less money I give away in fees, the more stays invested and compounds. I would track progress, not obsess over daily prices. Checking prices daily is a psychological trap. If I were investing in 2026, I would track my portfolio quarterly or semi-annually, focusing on contributions, diversification, and long-term growth. Markets move randomly in the short term, but directionally in the long term. Obsessing over daily fluctuations leads to panic selling, bad decisions, and missed opportunities. I would rebalance, not react. Over time, some investments grow faster than others. Instead of reacting emotionally, I would rebalance my portfolio periodically to maintain my target allocation. Rebalancing forces me to sell high and buy low, exactly what most investors fail to do naturally. This simple discipline improves long-term returns without requiring prediction or forecasting. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.